For a small group of traders, all this volatility isn't a risk they run from. It's the exact green light they've been waiting for. So in this video, I'm going to show you a simple strategy that turns all that market mayhem into your superpower. We're going to treat fear not as an emotion, but as a piece of data. So stick around because you're about to learn how to trade the panic instead of the politics. Let's be real. When the market is being thrown around by geopolitics, whether it's trade wars or oil wars, global conflicts, feels like a minefield. The reason most traders get burned in these situations is that they're just trying to predict the unpredictable. Market is unpredictable. Will a new tariff be announced? Is there going to be a new tweet? Is this conflict going to escalate in Iran? Will a late night tweet is going to dump or pump the market, right? So trying to guess these things is basically a coin flip. That's just gambling and not trading. Let's just be on the same page here. Markets crave certainty, and these situations are the exact opposite and create volatility. So the typical trader sees the news, watches the market drop, and sells right at the bottom, locking in a loss, thinking, oh, it's gonna go down more, and they're gonna enter at the very bottom. But you can never find the very bottom. They're always reacting to news that's already out there, always one step behind the emotional wave. You can't just win that way because by the time you react, the fear already is backed into the price and there's a recovery and you're late. But what if instead of getting tossed around by that wave, you could just stand on the shore, measure how big it is, and use that information to your advantage? I'm going to give you a certainty in the uncertainty. I'll give you the solution for that panic environment, and I'll give you a way to trade that fear and panic to your advantage. Okay, this is the part where we stop thinking like news junkie and start thinking like a pro. We need a tool that it can actually measure the market's panic in real time. And we have one. It's called the VIX, Fear Volatility Index. People often call the VIX the fear index, and it's for good reason, right? Simply put it shows us what the market expects volatility to be the next 30 days. So when the VIX is low, everything is calm, quiet. But when the VIX is high, fear is running the show. Investors are paying a ton of money for protection, like insurance against the market crash. They start buying puts, which makes the put prices very expensive, right? So now there's the big mindset shift. We're not using the VIX to guess where the market is going next. Instead, we're going to use it to use the level of the VIX to tell us when fear has become so extreme, so over the top, that it's created a trading opportunity all by itself. So the whole strategy is based on a concept called mean reversion. So the easiest space to think of the VIX is like a rubber band, right? So you can stretch it really, really, really far, but it always wants to snap back to its normal shape. So historically, those huge spikes in VIX, those moments of pure panic when it goes over 30, it doesn't last. Look at the chart. Our job isn't to predict the news that makes the VIX, nor is it to predict the news that makes it fall, right? Our job is to spot when that rubber band is stretched to its limit and make a trade that profits when it eventually snaps. Okay, here's the strategy. Let's just get into it and I'll show you how it works. It's very simple, rules-based strategy, no guesswork involved. You just wait for a specific signal and then you follow the plan. And it is a really great trading plan for this US government because there's a lot of uncertainty. So step one is our signal and it's super clear. We don't do anything until the VIX spikes above a specific level. For this strategy, our magic number is 25. Below 25, around 20, we just try to take our cash aside and wait for the VIX go above 23, 25. Why? Because when the VIX climbs past 25, it's like a flashing red light for fear. Something has clearly spoke the market, a conflict overseas, and surprise policy announcement or election jitters or some sort of war announcement, right? But here's the key for us. A high VIX means that the market insurance in the form of options contracts, puts, is not incredibly expensive. And this is the heart of our strategy. We're going to step in, act like an insurance company, selling this overpriced insurance to all the panicking trades. And we're going to be the one collecting the premiums. Okay. So when the VIX screaming past 25, we're going to go sell a put option on a stock that we would like to own. And this is a classic and highly effective strategy for this exact scenario. We made a ton of money for the last couple of weeks with that. And the concept is pretty straightforward. You sell a put option at a strike price that's way below the current market price. By selling this put, you collect a nice bit of cash known as the premium right away. You're trying to time the bottom perfectly. It's very important to choose a stock that you really trust fundamentally. Two powerful forces work for you: time and the eventual calming of volatility. Because we only make this trade when the VIX is super high, premium we collect is huge. This gives us what traders call more room to be wrong. If its market moves against you a little, the big premium you collected act as a cushion. In a high VIX market, you can sell an option that is much farther from current price while still collecting a path premium. I like to sell it between like point 0.2 delta. So, but the real magic happens when panic starts to die down, right? And that's where you're going to be taking a profit. This is the most important part of the strategy. It's where a lot of people can get tripped up. We're not holding this option until it expires. So important. Our goal is to rinse and repeat to cash in on what's called the volatility crash. Okay, remember the strange Brett's rubber band? We got into the trade when it was very, very tight. Now we're getting out and it snaps back to normal. So our exit signal is just as clear as our entry. When the VIX falls back down toward this average, usually dropping below 20, we close our trade. And when the VIX collapses, the value of the option we sold drops like a rock. And even if the stock market doesn't move at all, even if the stock that you sold the option doesn't move at all, because the volatility crash happened. An option you sold for $500 during the panic might suddenly be worth only $150. There's your $350 of profit. You simply buy it back for the cheaper price and just pocket the difference, right? You made money not because you guessed the market's direction, but because you spotted peak fear and bet that it would not last forever. And it never does. Look at the history. You sold insurance when it was crazy expensive and bought it back when it got cheap. Okay. But there are rules to this trade. You need to and know your edge. It's very powerful strategy, but it's not a free lunch. Selling a put option carries substantial risk if the market continues to plummet. So managing your risk is absolutely very key. And let's talk about the hard rules that will keep you safe. First, your trade size is everything. When the VIX is high, the market can make some seriously wild swings. You never ever go all in. A good rule of the thumb is to risk no more than 1 to 2% of your trading account on any single trade. In a market driven by unpredictable headlines, you should probably be even more conservative, and because you never know what's going to happen. Second, this is the most important rule: only sell puts on stocks you genuinely want to own. Stock selection is your ultimate risk management. Before you even think about the trade, ask yourself, if the market crashes and I'm forced to buy this stock at my chosen price, would I be happy about it? Do I know this stock? Right? What is the fundamentals? If the answer is no, do not place the trade. This way, if the panic gets worse and the stock falls, you're not losing. You're acquiring a great company at a discount you were already comfortable with when you set the trade. Okay, third, For those who want to use the strategy but with a built-in safety net, you can use a put credit spread. This is like selling a put with an insurance. You still sell the put option, but you also buy another put even farther away from the current price. That option you buy acts as a hard limit on your maximum possible loss. You'll collect a little less cash up front, but you'll be able to sleep at night knowing your exact risk is defined from the very beginning. And hey, if you're finding this breakdown helpful, do me a huge favor and make sure you subscribe to the channel. Okay, when not to use this strategy. This strategy is basically like a scalp trading, not a sledgehammer, but there are definitely times when you should keep it in the toolbox. This approach is completely off limits when the VIX is low, say below, okay? When the VIX is low, the market is calm and complacent. There's greed in the market. This strategy is for when the fear is in the market, which means auction premiums are very cheap. Trying to sell cheap insurance is just a very business bad model. The tiny bit of cash is not going to make you rich, okay? So in fact, low volatility is often when the market is most vulnerable to a sudden shock, okay? Which is exactly when a strategy like this can blow up in your face. This is the time when you raise your cash so when the VIX spikes again, you can allocate it. When the market is calm, you stack cash, sit on your hands, and wait. You wait for the fear to return. You wait for the headlines to get ugly, okay? That is your time to go to work. You just be patient. Okay, let's just tie it all together. The real secret to winning in a volatile, politically driven market is to stop playing the game everyone else is playing. Stop trying to predict the headlines and start trading fear those headlines create. That's where you're going to win. Geopolitical chaos from trade wars to global conflicts isn't a threat. It's a recurring, predictable opportunity to sell overpriced market insurance. While everyone else is glued to the news, emotionally reacting to every little up and down, or just trying to technically guess what's going to happen tomorrow, I think technically it doesn't work in this market. You'll be watching just one number, the VIX. You'll wait patiently for the market sphere to hit an irrational high, and when it does, you'll execute a simple, rule-based trade to profit from the inevitable return to calm, and you'll know when to enter and you'll know when to exit. Okay. You're not trading a person. You are not trading the outcome of a war. You're not trading an election. You're trading a statistical pattern using market panic as your personal entry signal to either generate income or to buy a great company at a fantastic price. If you want more real world strategies to turn market chaos into your trading advantage and make money, go ahead and hit that subscribe button, ring the notification bell so you never miss a video, and drop a comment below. What's the biggest challenge you face when trading in a volatile market?